Ticker symbol ACN has returned 35% in the past year, and today we'll be looking at a clear market leader in a highly demanded sector, and why TipRanks is giving this stock a number 10 for outperform based on a moderate buy analyst consensus, increased hedge fund trends, but sold shares from insider transactions. So we'll be looking at Accenture, a professional services company. In its annual report, Accenture defines its mission as helping businesses and governments build their digital core, optimize their operations, and accelerate revenue growth. They have over 700,000 employees in more than 120 countries, and they have been working with their top 100 clients for more than 10 years. So this is a recurring revenue that is rarely seen in the majority of the businesses, and it's what makes this quality business be so high quality. 47% of the revenues are derived from North America, 33% are derived from Europe, and 20% are derived from other markets that they call growth markets. Just for you to know, they spent over $2.5 billion in 25 M&A operations in 2023, and this is not rare. They are constantly pursuing different M&A operations to keep growing and scaling their operations. This company has around $65 billion in yearly revenue and growing at a pretty good CAGR. However, their financial analysis shines. They have a 20% return on capital employed, which is rarely seen for companies in this industry. They have an interest coverage ratio of 200 times, meaning that they do not have to worry about debt anytime soon. They have a stunning cash conversion of 101%, which is the ratio that defines how well a company does in transforming their net income into free cash flow. And they have a profit margin of 32% and an operating margin of 15%, which is in line to the operating margin that we usually want to look for. Now, the revenue, gross profit, and net income have been rising quarter over quarter, with their gross margin and net margin being extremely solid. And one thing about this company that it allows it to have such consistent gross margins and net margins is that they only take on projects that will allow them to maintain their margins. Meaning that if they have any project that will yield a margin lower than, for example, 8%, they will not even consider taking it. Now, as stated before, they are in a very solid debt position. They are not big fans of leverage, and their current ratio and debt to equity can prove to this statement. Just look at how their equity has been rising quarter over quarter, but their debt has been remaining pretty steady. Their efficiency ratios are through the roof, and if I remember correctly, the return on invested capital was the highest one in the professional services sector for 2023. So this proves that their management knows exactly what they're doing. In terms of fundamental analysis, Accenture has the perfect scorecard and yields an 8 out of 8 ticks, starting with the fact that they have very low liability risk and basically none. They have an extremely solid balance sheet. They can pay their short-term obligations with their current assets. They have extremely consistent, growing, and predictable free cash flows, and they pay a dividend, and they buy back shares, which is the double combination of what a good company should be doing to reward their shareholders. They have substantial pricing power based on their competitive advantage, which we will be discussing in a second, and they can provide organic free cash flow growth, largely due to their ability to grow their revenues organically. Now, they have a very large existing moat and a very wide competitive advantage based on their name, their past experiences, and of course, their know-how. They have a know-how that no other company will be able to contest them, especially in the technological consulting services, and I think they're here to stay for the longest time. Their dividend, they yield a 1.4% dividend yield with a payout ratio of 44%, which is pretty solid since it allows them to reinvest the remaining of their free cash flows into their business. As you can see, they have been raising their amount paid almost every quarter, but one thing to note is that their dividend per share is growing faster than their amount paid. What does this tell you? Well, this tells you that they're actually buying back shares, which enhances the increases of amount paid to dividends. Now, this company does follow secular trends since they are specialized in projects to allow companies to become more innovative, more technologically advanced, and become more digitalized. And the main two growth avenues that I always suggest are, first of all, geographical expansion, However, this company is already in 120 different locations and the development of new offerings, which they are currently doing so by providing new solutions. So this company has been managing to grow for the longest time, and I believe that they will still be managing to grow in a way that they have been growing previously, based on the fact that their management is ticking the right boxes and implementing the right initiatives. In terms of valuation analysis, I think it's extremely hard to buy this company at a low. Why? Well, this is because it's a fast-growing, extremely high-quality dividend payer stock, which is referred to as a long-term compounder, as their earnings are growing and compounding the returns of the shareholders. Now, in relation to the free cash flow yield, they yield a 4.2%, which is higher than the 3% long-term inflation rate, meaning that this company may be at an attractive valuation currently. Now, for the risk and possible challenges, I do believe that the main risks here are, first of all, the worsening of the competitive landscape, and second of all, the market economic downturns or cyclicality risks. The first one, the competitor landscape, is based on the fact that there are so many big consulting firms which offer very similar projects, very similar conditions, and very similar pricing, that Accenture will have to keep always innovating, offering new solutions, and being innovative to be able to have a higher value proposition or a better value proposition than their competitors. In terms of regulation, I don't see any possible upcoming regulation changes, and if there are any gearing towards technology or innovation, they will benefit from this, since one of their main solutions is guiding their clients and helping them understand what new regulations and new regulatory proceedings will do against their business. Third one, performance. Not meeting performance objectives. I put only a 30%. I think this is extremely hard for a company like Accenture. They have been meeting their performance objectives for the longest time ever. And as I stated before, these kind of companies, before they take on any new project, they have a very, very exhaustive approach on seeing whether this will help them meet their performance objectives or not. Finally, the one risk I do see as well is the market, the economic downturn or cyclicality risks. Technological advancements are usually seen as something that a company can dispose of. However, I'm going to challenge my point and say that these consulting companies do perform better when there is an economic boom, since companies have more cash to spend on projects such as this one and enhance their technology. However, whenever there is a downturn and companies are earning less and they need to fire workers or optimize their operations, they also hire more consultancy firms to help them manage the situation and approach the situation in the best way, enhancing their use of technology and being able to reduce their costs and becoming more efficient with their operations. So this 60%, I would lower it and change it more to a 30-40%. However, I do believe that this company is in a very solid position. So before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice. So please do your own due diligence before buying the stock. But I do believe that Accenture has a strong competitive advantage. They provide consistent, predictable, resilient, and most importantly, growing cash flows. And they have a high return on capital employed, meaning that they can create value for the investor. So I believe that this is a great company and a great investment, especially if you can get it at a low price. So thank you for watching. As always, this has been the Cash Flow Compounder. Please join the free Patreon in the link in bio for extra content. And there's also a link in bio for a free stock if you join Trade Republic and Trading 212.